All right. We're into the last third of May, May 20th. One thing about this morning that happened was bearish news over the weekend pushed us down 25 handles, a lot of big name stocks, tech, everything else was down. So it's like, is it priced in or is there another leg lower? So you get this bullish, or I'm sorry, you get this bearish sense like most people will get. And there's nothing easy about, well, the opposite is probable. But that's often the case when you gap open lower or gap open higher. You get people who are short from Friday covering, creating the buying. You get all the people that are bearish because it's obvious, trying to get short. Most people who trade aren't good at getting out of losers, so it creates this upside and almost gap fill. And one thing to look at when you're trying to understand structure and the health of a rally, the health of a break, is where did a move start? Not the whole day, just a move. Where did it start and how much has been retraced? So if you want to take swing low down in here up to a swing high, you don't know that it's going to rally back up to here. But what you do know at some point is halfway in between here and here, or 50%, has been holding. So far, the health of this rally, when I say this rally, I'm talking about this one, is still intact until we're down here, or if we get down here. So how much against the grain can you retrace before you start questioning that rally or that sell-off? And so we actually had this rally from here to here. You pull out and you say, you know what? It held right in here, pretty decent. But all of a sudden, after this long down bar, you start to scratch your head before this happens as to the strength and continuation of this market. This was the first time pretty much since the open that you had a retracement that came in more than 50% of the last decent move. And then you look at this move from here all the way up to here. This long down bar not only gets you to scratch your head as to the strength, but the fact that it took away 50% or more pretty quickly of the rally. Let me redraw it, of the rally from here to here. When you start to cut in 50% of that, you start to have to scratch your head as to, well, how bullish now is this market? And could this start to be the right side? Or could some weakness come in? Or should I stop being as aggressive on playing it from the long side? When you look at structure, just take the simplicity out of it, because you get so many people doing the obvious. If you could spot the obvious, see when it doesn't work, then you do opposite. Spot the obvious, do the opposite. But always start to look at the health of a rally and strength, or the health of some weakness based on the subsequent retracement. The word retracement, pullback, different words, same meaning. All right, same meaning. You should always be pulling fragments of the chart out. So you could, this is a range of consolidation boxes we always talk about. But a rally from there to there, you pull out. How healthy is the retracement? Well, if it could come in less than in here, that's good. But if it starts breaking more than that, you scratch your head in here as to the strength. You don't have to wait till down there or down here and be so surprised. That's what's important. Pull fragments of a chart out and a good periodicity that you're using and start to analyze if you're still right in the trade, if the health of the bullishness or bearishness is still intact. But most importantly, it's okay to be bearish this morning, 25 points lower. Everybody was. Most people are. It's not okay to stay bearish. It's not okay to keep fighting it. You have to understand the rubber band stretched, and oftentimes it wants to recoil back close to where it came from because some of the negative news is priced in. Sometimes the news is powerful enough to have that next leg lower. But when it's not, you don't want to be trampled by the herd, which often is the case with people that do the obvious too often.